Today's video is on TsLY versus JEPQ. Which fund is better? So we earn $100,000 a year in dividends in this channel, over $100,000, and we do it using margin, this 4 times purchasing power that we get. For every $1 you put in your account, you get $4, depending on your brokerage. And so we use this margin power, this 500,000 in purchasing power, to buy dividend yielding names that are high quality, 4-star funds in most cases, and these dividend funds pay down my margin debt of about $250,000. My performance and value shows you that this strategy is not totally insane, because we're up 19% for the year. The Dow's up 0.8, the S&P is up 9, and the Nasdaq's up 20. So the Nasdaq is beating us now. We were beating it yesterday, but now the Nasdaq is caught up. And that's why JEPQ is a good candidate. A lot of people are talking about JEPQ right now because people are trying to get more growth exposure. So JEPQ I like, but for many reasons I have chosen JEPI and a combination of Yieldmax funds to augment my yield per year, my dividend income. I'm augmenting it with the Yieldmax funds and then putting a larger concentration behind better tech funds that I see, like Cornerstone, CRF. It has a 20% dividend. We'll get into that in a second, but it's the Nasdaq. You have BST, EOS, ASG, and some others that I've mentioned before. So there are other high quality tech funds out there that you can use to concentrate most of your money behind and still get upside exposure. Whereas with JEPQ, the upside is capped because it's covered calls. So you have to understand that when you're getting this large amount of dividends per year using margin, you can't just buy all dividend yielding names that decay and go sideways or have their upside capped. You have to get performance as well. The Yieldmax funds will equally decline with the JEPQ. They sell covered calls, synthetic. They sell covered calls, and so their upside will be capped as well in the Yieldmax funds. However, if both funds are similar in nature, JEPQ and Yieldmax, and they both sell covered calls. Okay, so if they're having their upside capped, then why wouldn't you want to go with a portion of your money, let's say even a third of your money, in the Yieldmax funds, and then concentrate the rest in these other funds like I'm telling you about that have way higher dividends than JEPQ and have upside potential? EOS can move up, BST, I've shown you past charts of how to diversify away using margin, and see that past video, and it'll show you how to get upward, left, or right moving stocks that offset the decay of the dividend funds that go sideways or down. Whether it's due to selling covered calls or returning capital to you, these funds decay and go sideways. Like a lot of real estate funds, they don't sell covered calls, but they give you a lot of return of capital, and that's why the funds decay. So you have to get upward, left, or right moving funds, and the Yieldmax funds will move up some. As you can see, like NVDy down here, NVDy is up for us about 3 or 4%. NVDy right here, 6% we're up in NVDy, and I wish I had more in it right now, but again, the dividend has not been announced, and similar situation here for APLY. The dividend hasn't been announced. Let me just double check. I'm going to the APLY snapshot right now. See, the dividend's just not there. So anyway, but I'm using these Yieldmax funds because they control the same large cap tech that JEPQ controls. JEPQ has a lot of large caps, and APLY is a large cap tech, and so is NVDy. And so I'm using the Yieldmax funds for that same large cap tech exposure, that targeted benchmark exposure, but I'm getting more yield through the Yieldmax funds. And the only condition to doing this is you have to make sure you match the indexes. So you can't just put all of your money in an NVDy just because you think it's better than JEPQ. You have to match it to the indexes. Please see our past videos on NVDy and APLY on how we measure how much they're worth in the indexes, and that's how much of a percentage you should keep in your own portfolio. So you keep a small amount in these Yieldmax funds. I'm not saying go with Yieldmax over JEPQ, because JEPQ is safer and it serves a nice purpose in your portfolio. The only reason why I don't own it is because it's 50% maintenance. I own JEPI, it's 35% maintenance, but JEPQ is 50% maintenance. I've shown you this in past videos, but for some reason at eTrade, JEPQ is 50% maintenance, and JEPI is 35. So for every 1,000 I put in, 350 is taken up with JEPI. With if it's 50% maintenance, like in JEPQ's situation, which I'll show you here, JEPI, that's JEPQ. Let's go to JEPQ. You'll see that it's 50% maintenance. See snapshot, view margin, maintenance requirement, 50%. So every 1,000 I put into JEPQ, it takes up 500 of my equity. And that's this number right here. If I go back to my portfolios and show you these numbers, you'll see that this is the equity, 115. That has to stay above 0 so you're not in margin calls. And so this number is not really important. That's purely egotistical. I only make sure that as long as I don't sell from my shares, which pay me dividends, which, like, as you can see, cornerstone right here, quantity right here, as long as I don't sell these shares, okay, it doesn't matter what the market value does, they will keep paying me dividends and cash flow the positions over time. A 20% dividend in 5 years, it pays itself back no matter what the market does. And JEPQ, it takes a lot longer. It takes 10 years on a 10% dividend, or 12% roughly in JEPQ. And so JEPQ, again, I've showed you past videos of JEPQ. If you want to see its holdings and more about the fund of JEPQ, go see my past videos on it. But this video, I'm really going to just share with you a strategy on how best to use all of these funds together. If you didn't have eTrade and you're in a different brokerage, I could see you using JEPQ as part of your strategy. But for me, it takes up too much equity, as you know. There's nothing I can do about it. I can't make that number go anywhere close to 0, or I'm in a margin call again. And this is my number of debt right now, $255,000, in case I didn't show it to you already. And the interest I negotiated down, and I was able to do it because I have a large account size and because I trade frequently. So if I'm charged around 5%, then none of this matters. Even if you're charged 10% on your interest, which isn't that much, to tell you the truth, these Yieldmax funds more than cover it. Same for Cornerstone, 20% dividend, and more than covers that interest. Plus, Cornerstone gives you the drip, which all these little $6 lots are the NAV price. The price, the stock never reached that price. You 21% dividend. Let's see, 6, 9 here. Okay, 6.6, 18% dividend. All these are drip from Cornerstone. The dividends per month, $3,000 a month, $3,500 a month we make in each dividend Cornerstone fund. They drip them at the NAV. They reinvest the dividends back at the NAV, not the market price of $7.86. So if you need e-guides on how to use margin or how to play Cornerstone, just email me at akintalk48@gmail.com. I have those e-guides. And if I can't get back to your comments in time, by the way, please forgive me. Some of those comments don't even show up in my alerts. So email me if you want to talk more in depth about anything. So JEPQ, that's why for me, that's why I'm not using it. If it's 50% maintenance and Yieldmax funds are 50% maintenance, because they are, I don't know if I showed you, but OARK is 50% maintenance, for example. If they're both 50% maintenance, why wouldn't I go for the higher yield? Okay. And if both have upside capped by selling calls, then why wouldn't I go with Yieldmax, who has the larger dividend? Both control large cap tech, but only one gives you more qualifying income to the banks, which are Yieldmax funds and Cornerstone, like I've told you, because the more dividends you have, the more qualifying income you get to live financially free. You can't use trading for qualifying income. It's too up or down. The banks won't accept it. And I also don't understand other channels who just talk about stocks and random stock market events and try to predict where everything is going when you can't. No one has a crystal ball. You just have to buy the indexes. That's the only way you could win. See JEPQ here, 50% maintenance. Oh, no, Yieldmax funds, I'm sorry, OARK, 50% maintenance. So if they're both the same maintenance, why not go with the higher yielding funds? But you don't put a lot of money in the higher yielding funds. You target them to be only as much as they are in the S&P and NASDAQ. So again, TsLY, if that's 3 or 4% of the NASDAQ, then it'll be no more than 3 or 4% of my portfolio. And TsLY, as you can see here, we have 9,000 in it, so it's not more than 3% of my portfolio. I'm actually very underweight, and it's low risk. So I could actually add more to these funds, APLY, NVDy, TsLY, and be nowhere near overweight according to the benchmarks, which makes my portfolio not as risky as you would think because they're just tied to the indexes. And however those stocks go, I don't care because that's how the index goes. As long as I stay in line with the indexes, then I don't get surprises on margin calls. And that's the name of the game. Just live financially free, keep this cushion high enough to where even when you get a market drawdown of 10 to 20%, you're still okay. All right. Don't use as much margin as me, by the way. Use, 10 to 20%, maybe 30% max. Don't go anywhere over that, especially when starting out. Maybe if you get more comfortable with it, you can do what you want. This is a free country, but I don't want you to ever get hurt based on my recommendations or anything. All of these recommendations I'm making can all be done without margin. All these strategies that I use, they can all be done without margin. Don't you have to ask yourself the same question? If upside is capped on both funds, don't you want the higher yield? Yes, so you go with Yieldmax, but you don't want all the risks. So you go into you concentrate the large amount of your money into the indexes like Cornerstone, which is NASDAQ, or even a BST, which is 10% yield. I realize it's not 20, but it's not covered calls as much, so you can get more upside exposure. Look at a BST on its chart. As you can see, it moved from 30 to 60. That's after Corona. That's a 100% move. See, 30 to 60. So I can't zoom into that, but 9% dividend, and it'll move upward, left, or right for you. So anyway, this is my feeling on JEPQ. This is my belief. I actually like the fund, but it has 50% maintenance. There's nothing I can do about it. So I've switched into these other Yieldmax funds, but I don't put too much in the Yieldmax funds, only what it is and what they are in the S&P. Sorry for repeating myself, but you have to listen to this if you're going to actually use margin. You have to peg everything to the indexes. You can't tie it to all these other funds. And even if you're not in margin, you still have to peg everything to the indexes, because all those other funds that you like that are covered call in nature or real estate or give return of capital, and they decay over time. So you don't really get ahead much. So I just use the margin to get ahead, since it's low interest and it's better than credit cards, which are 20% interest. And when you pay back your margin here, the $300,000 that I have in debt, or the $250 that you see below, the $100,000 that I earn in dividends will pay that debt back in 3 years, assuming I don't spend out of it or take any big losses or get some massive dividend cuts. They'll pay that back in 3 years. And then this grows by $300,000. Your credit card bill, if you just pay that back, it goes to zero. If you pay back your debt in eTrade, your account grows. It's like paying back your debt in your own house when you refinance it and you do remodeling and repairs on your house and you put it back into the house. So it's the same thing here with eTrade. So I hope you understand my strategy. A lot of people own JEPQ, and it's no offense to them. Like, I really actually like JEPQ, okay? It's just how eTrade does it here. And it allows us to get the performance that we get. You have to have performance to have cushion from margin calls. When the market does fall, if you're in margin, you want to have cushion from margin calls. If you aren't in margin, well, then don't you just want the max performance that you can get possible? So anyway, I digress. That's how I'm playing JEPQ. I'm taking Yieldmax funds over JEPQ, and then putting the rest of my money. I'm only putting a small amount in the Yieldmax funds, putting the rest of my money in the larger indexes, the 4-star funds that pay you still healthy dividends and qualifying income to the banks, and they help you live financially free. So if you have any questions, leave them in the comment section below. If I miss your comments, again, email me at aikentod48@gmail.com if you want to talk more in depth, and I'll talk to you soon. Thanks.